Morning, everybody. I think we'll get started because my watch says it's 10 o'clock. I know you're all busy. So welcome to the latest in Headstar webinar that's aiming to inform our professional community. My name's Sue Moul and I'm Head of Fractional CFO Services within Headstar. And I'm delighted to welcome Anna Pickup. I'm just going to do a brief introduction and then I'll be handing over to Anna to take us through her slides. So for those of you who don't know Anna, she's the Associate Director in Consulting at RSM. She's got over 14 years experience working within professional services, specifically looking at financial reporting for SME businesses and groups under UK GAAP and IFRS. And at the moment, or certainly for the last few months, she's been leading the process for looking at the upcoming changes to FRS 102, which is what we're going to be talking about this morning, specifically involving leases and revenue, and has also got a wider experience in audit, valuations and business modelling. We will have opportunity for questions. You can put something in the chat and we'll pick those up at the end, so please feel free to do that. And if you do have to drop out of the webinar, we will be recording this and sharing it later, so don't worry if you need to go. Right, Anna, over to you.
Thank you, Sue. I don't think I really need to do much more of an introduction after that. I wasn't expecting the bio, but I suppose just to say a little bit more about the finance function support team here at RSM that I sit within. So as well as kind of statutory compliance work, we do accounting advisory work and, outsource finance function in total, as well as helping finance teams just generally become more efficient and effective, whether that's through the use of data or digital tools, that sort of thing. But yes, most of my time is spent on financial reporting advisory work. So today's topic is a topic that has been talked about for a number of years now, whether that was through the consultation phase or the period since it became since it was kind of confirmed last year. But we're now only 6 months away from these new accounting rules coming into play, so we're getting closer now. So yeah, this relates to changes to UK GAAP and specifically FRS 102. Whilst changes to accounting standards is generally a difficult topic to get people excited about, hopefully, given the audience today, it might not be as difficult for me, but I'll try my best anyway. But as well as talking about the changes in the accounting rules themselves, we'll talk about what are the kind of commercial and practical implications of this as well. So some of you might remember some pretty significant changes being made to IFRS back in around 2018. So there was a new revenue recognition standard, IFRS 15, brought in, and a new lease accounting standard, IFRS 16. And the changes to FRS 102 that are coming in are intended to align UK accounting standards with those international financial reporting standards. And, the purpose of this is to enable comparability of accounts for investors and users of financial statements. So just mentioned two key areas of change are accounting for leases and in revenue recognition. There are some other areas of change as well, which we're not going to go into detail today, but it's definitely worth familiarising yourself with those changes. So there's some changes relating to fair value accounting, accounting for business combinations, as well as kind of disclosure requirements as well. So it's worth having a look at those, but we'll spend a bit of time on lease accounting and revenue recognition today, talk about what the impact of that might be and how you might prepare for the changes coming in, and then just a couple of minutes on how we at RSM are supporting our clients with the changes as well. And then, yes, we'll have a bit of time for Q&A. So I think, Sue, you'll monitor those questions if there are any.
Yeah, you don't need to worry about that. I'll capture those, Anna.
That's good.
At the end.
Fab. So The majority of the changes are effective for accounting periods beginning on or after 1 January 2026. So the first set of annual statutory financial statements we'll see them in will be 31st of December 2026. However, there are some changes relating to supplier finance arrangements that are already effective. So they're effective for accounting periods beginning on or after 1 January 2025. So don't want to go into too much detail on those, but this relates to where businesses have got, whether it's supply chain finance or reverse factoring, it's referred to in a number of ways. But those companies will have to disclose a lot more in their accounts about those sorts of arrangements if they've got them. So, what's the quantum of liabilities on the balance sheet that are subject to those types of arrangements, whether there's any key terms and conditions associated with them, what guarantees have been provided. Generally, a lot more disclosure on those, which, can be quite commercially sensitive information. But so those changes are effective this year, but otherwise next year. However, there is the option to early adopt the changes to leases and revenue recognition. So if you would like to adopt them in December 25 accounts, you can. And, we are seeing some clients choose to do that for a number of reasons. So that is an option. I guess just from a management accounts perspective, you probably want to be thinking about applying these changes from, if you produce monthly management accounts, from January next year. You don't really want to go the whole way through 2026 accounting under the old rules, and then at the year end, having to explain to stakeholders why your numbers could look, in some cases, significantly different to those that you've been reporting throughout the year. So whilst, 31st of December might still seem quite far away, there could potentially be quite a bit of work to do in preparing for these changes. So we're just trying to encourage businesses to start thinking about it now, and taking steps to prepare. So I'm going to start with leases, because I think the changes to leases are probably the easier of the two to kind of get your head around what the impact might be. So the changes relate to accounting as a lessee. So if you're the lessor of an asset, the accounting in that instance is largely unchanged. But here we're talking about lessee accounting. And under current FRS 102, current rules, we have a distinction between operating leases and finance leases. And there's been quite a bit of kind of discretion and judgment in determining which you have, and the accounting treatment is quite different. So a finance lease, you have an asset and a liability on your balance sheet, whereas an operating lease, you recognise your rental charge, whether it's monthly, annual, through your P&L as an expense, and so that's included within your operating profit or loss result. But the changes remove that distinction, and there's just a single lease accounting model. So all leases will come on balance sheet. So you'll have a right of use asset, and then you'll have a lease liability for the commitment you have for the future rental payments. So there are some exemptions. So if you've got leases relating to low value assets, or if you've got short-term lease, so say a lease of less than 12 months, you don't need to recognise those on the balance sheet. You can still continue to expense those rental costs through the P&L. Unhelpfully, the standard kind of doesn't give a monetary value as to what low value constitutes. There is some judgment, but it does give some examples of assets that wouldn't be considered to be low value. So like motor vehicles, they wouldn't be considered to be low value. But what we've seen in practice, things like laptops and photocopiers, water coolers, they probably would be considered to be low value. So you could use the exemption in that instance. But for all other assets, we have this new single lease model. So you would recognise if we start with the lease liability and the initial measurement of that, you work out your total lease payments and you discount that to present value using an appropriate discount rate, which we'll come on to shortly. And then your asset is that lease liability plus any direct costs that you've incurred in entering into that lease. So, your asset and your lease liability are not necessarily going to be the same value. Subsequently, then, your asset is depreciated. So you have a depreciation expense in your P&L. And your lease liability, you recognise interest each period, and then you reduce the liability for any actual cash payments that are made for that lease. So in terms of the P&L then, rather than having an operating expense, we now have depreciation and interest instead. Just to kind of highlight that this isn't impacting cash accounting, this is an accounting adjustment. It's not impacting cash flows. This bit anyway, and we'll come on to the potential impact on tax. But we're not changing here what our rental payment is. This is an accounting adjustment. So I just mentioned in terms of measuring that lease liability, we need to discount the future rental payments to present value. And the standard gives a number of options in terms of the discount rate that you can use to do that. From when this came into IFRS 16, this is probably one of the trickier elements that we saw, is kind of determining what the appropriate discount rate to use is. So what this coming into FRS 102, the Accounting Standards Board have tried to make it slightly simpler by giving a number of options. But the default in the standard is the interest rate implicit in the lease, which is quite difficult as a lessee to determine because it requires you knowing about the lessor's finance arrangements, which, as the lessee, you don't really have access to. So that's quite difficult. So the next option would be the incremental borrowing rate. And this is an asset specific rate. So what would it cost you as a business to borrow a sum of money to fund the purchase of an asset equivalent to that asset that you're leasing, over similar terms to what you've agreed in the lease, so over a similar lease term period. So that's an asset specific discount rate, which again can be quite difficult to obtain. So the next option, and probably what we'll see most often used, is the obtainable borrowing rate, which isn't asset specific. It's just generally what would it cost in the current market to borrow a sum of money needed to fund the purchase of that asset that you're going to lease over a similar period. So if you've got kind of recent borrowings, you've done a financing exercise, that might be something, that's more easy for you to determine, what it would cost you at that point. It might be something you need to have a chat with, if you've got a bank manager, relationship manager, it might be something that you want to have a chat with them. Or it might just be something that you kind of need to spend a bit of time putting together a good estimate. So, from our experience, this is a focus area for auditors, because it's going to impact the measurement of the liability. But, it's recognised that this is a highly judgmental area. And what we see is that kind of, it's generally note 2 in the financial statements relating to significant accounting judgments and estimates that we'll see that the estimate of the discount rate disclosed in there. So yes, something to think about. So what's the overall impact on the financial statements of the leasing changes then? So in the P&L, we'll see an increase to EBITDA because, that operating expense is being replaced with interest and depreciation, which is excluded, obviously, from the EBITDA figure. But we'll see profit before tax decrease. And that's because we'll generally see higher interest in the earlier years of the lease when the lease liability on the balance sheet is greater. So the kind of profile of the interest expense, we'll see it high at the beginning of the lease term and then tail off towards the end of the lease term. On the balance sheet, we'll see an increase in total assets because we've got these right of use assets. And we'll see a decrease in net current assets because we've also got a current liability relating to the rental payment that will be due in the next 12 months. And then gearing, obviously the business will look more highly geared because of the additional liabilities on the balance sheet. And then just a quick point on ratios there. I'm losing my voice now. I'm going to have to stop and have a quick drink. But the interest on ratios as a result of all the other changes which are inputs into those ratios. So just included a slide here on some practical considerations. So from when this came into IFRS 16, these are some of the things that businesses struggled with that we just wanted to highlight. So in terms of the operating lease commitments note, so this is generally a note that's tucked away at the back end of the accounts, sometimes done very well, sometimes not done so well, but kind of summarising what operating lease commitments the business has over the next few years. Excuse me. So under IFRS 16, when that came in, you actually had to provide a reconciliation from the last operating lease commitments note that was disclosed to the lease liabilities that were recognised on balance sheet, which hasn't come in. That requirement hasn't come into FRS 102. But what we are expecting is that auditors are likely to use that as a bit of a completeness check. Having a look at what that commitments figure was in the last accounting period compared to the liabilities that are brought on balance sheet. Gosh, I'm used to doing a lot of talking, but for some reason my voice is going today. So I guess just top tip then is for this year end for 2025 is just to really spend some time looking at that operating lease commitments note and linked to point 2 on the spreadsheet as well. Pulling together the lease information that you've got is kind of not always to hand, lease documentation and readily available, but maybe start thinking about getting that information together now, because you will need to look at it and you'll need to consider specific terms in those lease agreements, whether there are break clauses, different elements of consideration, if there's any elements of variable consideration perhaps. There are different accounting rules that have come in that mean those factors have to be considered. So just as a whole, start to think about pulling that information together now. Intercompany leases, so they still fall within scope of the accounting rules. So start thinking about whether you have any of those that exist. It may be that there's no formal agreement between the different companies within the group, but it might be a good time to formalise those arrangements now and document those to then support the accounting. And then just finally, the impact on systems and processes. So, Excel is obviously a good tool, but if you're in a business that has a significant number of leases, it might be that you'd be better off using some sort of leasing software. There are some good ones out there. We're using AI to help with our lease accounting when we support clients. There's different platforms available to support with that. But just thinking about whether your current systems are set up, to account for these changes. So moving on to revenue recognition then. So, revenue recognition, under current rules, it's an area where there can be a lot of judgment, and it's going to be the same going forward. But now FRS 102 reporters will have to follow this 5-step model, which is what was brought in as part of IFRS 15 into IFRS. So there's we'll talk a little bit about each of the steps, but what I would say is there are intricacies in the rules, kind of at each step of the model. So it's definitely worth familiarising yourself with those. But the overall concept and the overall change is we're kind of moving away from this concept of revenue being recognised when risks and rewards are transferred to this concept of recognising revenue when control is transferred. And control is defined in the standard. So, that's what we see. That's kind of the gist of what is changing. But that means that revenue could be recognised at a different point in time to what you are currently recognising revenue at. So revenue will either be recognised, so it's step 5, at either a point in time or over a period of time. And what we are seeing is that under the new rules, like I just said, that could be a different. So whereas perhaps you might have recognised revenue on delivery of a product, it might be that actually control has passed at a point before that. So you would recognise revenue at an earlier point in time. Or it could be the other way around, where you've been recognising revenue over a period of time, but actually control doesn't pass until you've delivered the product to your customer. So probably the most difficult step, I think, and the biggest change for companies is step 2. So identifying the performance obligations in the contract. So we like to call them promises. So what are you actually promising your customer? And, where this is going to make the biggest difference is where you're perhaps promising a number of things bundled up into one offering to your customer. So, for example, in the case of a tech business, it might be that you are providing software, hardware, ongoing support services, installation services, whereas you might have considered yourself to have one performance obligation currently, that's actually 4 different performance obligations. And what you have to do is recognise revenue for each one of those separately, like when you've fulfilled that performance obligation. In the case of, say, a manufacturing business, perhaps, if you are manufacturing a bespoke product, it might be that you currently recognise revenue on delivery, but actually what you are promising is design services, the manufacturing element, an installation service, a warranty. All those things could be considered different performance obligations. So companies are really going to have to look at their contracts with customers and break them down and identify what those performance obligations are. So you then determine the whole transaction price, so the whole value of that contract, and then allocate that transaction price to each one of those performance obligations. And there are rules in how you do that allocation. So generally it's based on standalone selling prices, but it might be that, there isn't a standalone selling price immediately obvious, so you have to do a bit of analysis to work out what that transaction price is. And then when you consider that control has passed, and again, there's a definition of that, then that's when you would recognise revenue. So overall, your transaction price could stay the same, but the kind of timing and profile of revenue recognition could be quite different under the new rules compared to current rules. So I guess just to give a practical example of how this works, and I don't know whether it's the best example, it's the one we use all the time, whether it's the best in terms of people on this call relating to it. I'm not sure, like it being similar to what you do in your business, but we'll take the example of a mobile phone contract. So where your customer is paying, say, well, £50 a month in this example. And under the old rules, the telecoms companies, would have recognised £50 a month. Oh, skipping on. Would have recognised £50 a month revenue. Whereas actually under the new rules, when you look at what the actual performance obligations are in the contract, one is to provide the handset, and then one is to provide the ongoing kind of data, calls, texts, that sort of thing. So there are actually two performance obligations. So if we look at what the total transaction value would be, so it's a 2-year contract, 24 months. So total contract value is £1,200. And then per step 4 of the model, that needs to be allocated to the two performance obligations. So in this case, £600 has been allocated to the sale of the headset. And then the remainder is what needs to be recognised monthly whilst the contract is being provided. So you can see that I don't know if I've got another slide here, but the profile of revenue recognition has changed quite significantly there. So they've got £600 revenue on day one, and then less revenue going forward compared to the £50 per month that was recognised previously. So what's the overall impact of the revenue recognition changes? Well, like I just said, it's that timing and profile of revenue recognition, and then what impact that has on tax. Your taxable profit could be impacted, which then impacts cash flow. So just popped a slide on here on kind of application of the changes. So with the lease changes, those can only be applied prospectively from 1 January next year. So in that first year of application, your financial statements are going to look quite odd. There will be a lack of comparability between current year and prior year, because in the current year, under the new rules, you'll have all these assets and liabilities, which you didn't have in previous years. So, for someone outward looking in, those results could look quite unusual. So it might be something you want to educate your stakeholders on and, let them know to expect. With the revenue changes, you've actually got a choice whether to restate your comparatives or to apply prospectively. If you do apply prospectively, you still have to apply it to your open contract. So you might have an opening adjustment to retained earnings on 1 January 2026. So I guess these points here apply to both the revenue and lease changes. So, adopting these changes for the first time, could be quite time consuming in preparing. So it's going to be different depending on what industry you are operating in. Some will be more heavily impacted by the lease changes than, say, revenue changes. So, for example, retail and hospitality businesses, we're expecting those businesses to be significantly impacted because they have a lot of properties and stores and restaurants that are held under operating leases. Whereas the revenue piece might be more straightforward for those businesses. I don't want to say they're not impacted at all, because there are some considerations to make in terms of loyalty schemes and accounting, like where you've got gift cards and that sort of thing. So they're not completely kind of excluded from the changes to revenue recognition, but they'll probably be more impacted by the changes to leases. Whereas if you've got, say, a tech business, or software business, we're expecting those businesses to be more impacted by the revenue changes. And, in terms of looking at that 5-step model and doing that analysis, that could be quite a time-consuming exercise. Just thinking about the impact on what your P&L and balance sheet looks like, thinking ahead, educating the stakeholders of your accounts, people that might be looking at your accounts, on why they might look different going forward. And then we talked about, the impact on revenue, profit, EBITDA of both of the changes. If you've got financing arrangements or kind of performance-based remuneration, employee incentive schemes that are based on those measures, then you want to be thinking about how they could be impacted and how you might want to consider the impacts of these changes in those measures. We're spending a lot of time talking to the banks about how they might look at changes in EBITDA and the impact on debt covenants and that sort of thing. And, there is this concept of frozen gap that can come into play in financing arrangements. So, it's based on accounting rules at the time of entering into those arrangements, which is fine. But, as a finance team, it means you're going to have to track 2 sets of numbers, one for your statutory reporting and then one for your debt covenants, or, to monitor if you've got earn-out arrangements, for example, that are based on EBIT revenue or EBITDA growth, that sort of thing. You're going to need to track, 2 sets of numbers, which could be a bit of an admin burden. And we talked about the impact on tax. So, if our revenue and our profit figure is changing, what impact is that going to have on tax? We are still waiting for HMRC to confirm how they're going to treat these changes, which we haven't had yet. But, we are expecting it to follow the accounting. That's what happened when it came into IFRS. The tax treatment generally followed the accounting rules, but we are still waiting for confirmation of that. Again, just what impact this could have on your systems and processes, how your current systems capture data relating to contracts, relating to lease agreements. Are you able to capture all the different terms and conditions to enable you to do the accounting correctly? And then just the potential impact on future contracts. So clearly, different key terms and conditions you put into your revenue contracts and perhaps lease contracts can impact the accounting and therefore what your results look like. So it might be that if you're looking at future contracts now, you want to be thinking ahead to what the accounting could look like and, what you would like it to look like or not look like. Sorry, I just clicked off an error on my screen and I've moved on. But that might be something where, as a finance team, you also have to educate other teams within the business, whether it's the commercial team, the sales team, those people are going out and agreeing contracts with potential customers. but actually have they thought about how the slightest, clause in a contract, for example, could impact the accounting quite a lot. So we are only, like I said, we are only 6 months away, 6 months exactly away from kind of the effective date. So how can you start preparing? So firstly, I guess, you've taken the first step by signing up to this webinar today and familiarising yourself. Hopefully I've given you a good overview of what the changes are and what they mean. But, really having a think about how your business could be impacted. So I've just popped a link there to our Bridging the Gap page, which has lots of kind of articles on the topic. We've got lots of sector specific articles. So, covering key sectors, whether it's real estate, tech, consumer products, healthcare, life sciences, financial services. We've got lots of different articles on there, which you might find useful. Then going into the assessment, of how you might be impacted. So, what, like I said before, what assets you've got under a lease. What I didn't mention was that you might have assets that now fall within the definition of a lease that didn't previously. So that might be something to think about. And then looking at your revenue contracts and kind of alongside the 5-step model. Again, making sure that you've got all your documentation to hand, whether it's leases, revenue, speaking to your stakeholders, speak to your auditors about it. And then again, thinking about the impact on systems and processes. So there is quite a bit to do. So just quickly then, how we are supporting clients at the moment on this. So we can do that, initial impact assessment. We can look at financial statements against the changes and consider where you might be most significantly impacted. So we've got a new digital tool that we're using that produces like a traffic light report, that shows whether you'd be highly impacted or, unlikely to be impacted. We can help do the calculations. We can do the revenue contract analysis if it's not an RSM audit client. There's some kind of boundaries in terms of what you can do as an auditor and advisor. We can't obviously make management decisions and that sort of thing. But we can help prepare accounting policies and support for your audit, and help you prepare the disclosures that will be needed to be made. We can also look at, well, actually, would you be better off just applying full IFRS, or are you better staying as an FRS 102 reporter? And then we can also do training. So we can come do a training workshop with your team, say on revenue accounting, on lease accounting, to enable you to have a go at doing the work yourself, or we can just support you on it directly. So again, just a couple of links. There's our Bridging the Gap page. I think, Sue, is the plan to share the slides? Are you able to share these slides afterwards with everyone?
Yes, I'm being told we can, yeah.
Yeah, fab. And then there's a recording of a webinar that one of our partners, Danielle, did at the end of last year, which also might be worth taking a look at. And I think that's probably it.
Okay, well, we've got, actually, I'm not surprised, but we have got a lot of questions in the chat, Anna. So I think you'd have a swig of water. And I've got a question, because I'm the host, I'm going to go first. So in terms of the timescales, I know we're saying it's December 26 and we should start our management accounts from early next year. But if you've got a March 26 year end, you've been doing management accounts 3 months, getting ready. But what are we how do we do it when we've
What's
got
the
a
timeline?
year? Yeah.
Yeah, so it's because it's accounting periods beginning on or after. So if you've got a March 26 year end, your first annual statutory set of accounts will be March 27,
All right. Okay.
unless you choose to early
Unless you want
adopt
to.
and apply the changes in March 26.
Yeah. Okay.
But yeah.
That's helpful. Thank you. Right. Let me just have a quick look at the Q&As. That was about the slides. Somebody's asked, do we have an Excel template for leases? I think you've referenced some lease software, haven't you, that might be available?
I mean, yeah, I can't advocate for any, we have a partnership with an AI platform that we use for our work. You can, you could quickly Google lease accounting software, but in terms of an Excel template, that's not something that we would really provide. If you've only got a small number of leases, the way we would support a client would be we would either do the annual lease calculations, and we might use Excel, if it's a fairly straightforward lease. I'm not sure whether, it might be that we would provide that lease document, but obviously it would be subject to the caveat that if you agree new lease terms, that calculation might change, which means that spreadsheet's outdated. So I'd probably recommend kind of keeping in touch with your advisor on
agreed.
What that accounting should look like.
And then we mentioned working out what the discount rate was. So, for example, if the organisation's got no borrowings and you can use cash, then is an appropriate discount rate basically the cash on deposit interest rate you would get, because that's your opportunity cost, presumably, but you were borrowing, weren't you?
Yeah, I think it's the borrowing rate. So it's unlikely that you would be able to borrow at that rate, at that cash deposit rate. So
when you need a conversation with your banker, then friendly banker, to give you an indicative rate.
Yeah, and from speaking to bankers, it's not something that they can just off the cuff say, oh, your rate would be this. Quite a bit of work goes into coming up with how much they're prepared to, that interest rate that they're prepared to lend at. It's probably worth a conversation with them. But I think I think it depends on the magnitude of leases you've got and how material this is in your accounts. But I think if you can come up with a sensible estimate, we see the starting point as a risk-free rate plus then any adjustments for kind of credit rating and risk for the bank and that sort of thing. I think if you can come up with a sensible discount rate, your auditor might be able to get comfortable. We are, as a firm, talking to the FRC about what they are expecting from businesses, for example, that don't have current borrowings. So I think that's unhelpfully, it's a little bit of a watch this space in terms of what they are actually expecting, the level of support to give that.
But presumably it's you really should be documenting where you've got that rate from, because a year further on things might have moved on, might there, and things, so you need to have a reference point for your decision. Would you mind just stopping sharing your slides, Anna, and then we can see you a bit better, and I'll go through the other questions. Thank you. Would the new lease accounting changes be applicable to rental payments to landlords for office space?
Yeah, so probably what I didn't mention actually is that this is going to impact any business that is renting an office space. Any business that has a long-term property lease. This is where there's going to be a big impact of this, because those agreements that were previously held off balance sheet, we're now going to have on balance sheet. So yes, this applies to the lease of office space.
Yeah. Okay. If a lease is part way through, for example, 2 years of 5, would you post a catch-up for depreciation, interest and reduction in liability as at the 1st of January 2025?
Yeah, so with the lease accounting being prospective, you have that catch-up adjustment to retained earnings on day one of the accounting.
So in your disclosures, there'd be a little note, would there, of adjustment to reserves?
Yeah, we're expecting to see a reconciliation of those opening reserves and the adjustment that's been made to them.
Yeah, well, we'll all love a reconciliation, don't we? So
We do.
Oh, yeah. So this sort of covers my point. Is the discount rate determined solely at the start of the lease, or does it require periodic reviews if you based it on your own borrowing costs?
So the initial calculation is done at the inception of the lease. Apart from, on transition, we'll have it as at the transition date. There are some instances, and I'd probably have to go back and check the rules, to be honest. There are some instances where you look at modifying the lease accounting, in your lease calculations, if you've got kind of a modification in the contract. But yeah, I'd have to have a look whether it says anything specifically about updating the discount rate. But the initial calculation is at the inception of the lease.
Okay. And sort of on the same thing, lease, we're getting a lot of questions on this. If you had a 25-year lease with rent reviews every 5 years, do you make an assessment of that increase when you value the future lease commitment and then your subsequent discount?
Yeah, so I think there's 2 points there. There's kind of the consideration of what your lease term is when you've got kind of break clauses. You would look at the earliest period you're expected to kind of end that lease. So it might be that you have a break clause after 5 years, and it's probable that you will exercise that break clause, in which case your lease term would be 5 years. But if you've got history of carrying on each 5 years, it might be that actually the lease term is longer. In terms of the consideration, so I didn't go into too much detail on it today, but there are rules on what you include in those lease liabilities. So, we have kind of fixed payments, so those payments that don't change, but then we have this concept of variable consideration. So the rules say that you would include any variable consideration that is linked to some sort of index or rate. So if you've got an adjustment based on inflation, for example, those payments you would include and you would take into account. If you've got variable consideration that's linked to, say, turnover, that wouldn't be included in your initial lease payments. So it's definitely worth having, if you have those sorts of terms in your lease agreements, it's definitely worth having a little look at that bit of the standard that explains, what you include in that lease liability on day one.
Okay. I think we're moving on to sort of revenue questions. So business offers a 15-year warranty. So would part of the revenue not be recognised until the 15 years is over?
So with warranties, you have to look at what kind of warranty it is. And there are 2 different types of warranty. Is it just kind of a warranty based on quality? For example, you have to consider whether actually, or are you offering a warranty that could be a separate product, a separate performance obligation. So the way warranties come into it is whether you have a separate performance obligation. Again, there's more guidance on warranties in the standard, but if you determine that it is a separate performance obligation, then obviously you would account for revenue separately for that. And that could be over a period of time or at a point in time, depending on the terms and conditions associated with that.
Yeah. Okay. This next question is also about warranties. So revenue recognition for a manufacturer with customer rebates and overriders be a deduction from revenue or be reported as an expense?
So rebates. Yeah, rebates you'd have to consider in that, that step 3 of the model in determining the transaction value. That would fall into that. So you would have to consider, how much, like what is the consideration that you're expected to receive overall. So rebates, I'm not quite sure how it fits into that expense point, but it's, the rebates bit fits into that transaction value piece and what genuinely, is the consideration in the contract.
Okay. Somebody's asking a question about salary sacrifice schemes. Could the changes to lease accounting impact companies offering salary sacrifice? Could be quite a significant exposure. Are there transitional rules for this?
I think I'd have to defer that one to one of my to one of my tax colleagues. Definitely follow. Yeah, I don't know if you can share that one with me, Sue, or if the person that's asked it wants to get in touch with me separately, so I can have a think about that one, and maybe we can share the answer with everyone if it's going to be applicable.
And it's about 10 to 11, so I'll move on to the last one. We're nearly done. So, is there a difference between office lease and a license to use, for example, Regis or Wizoo or somebody? So is that a different treatment in those examples?
So it could be that falls within lease accounting rules. So if you've got the don't know if I'm going to be able to reel off the actual definition, but in general, it's whether you've got the right to use an asset over a defined period of time in exchange for consideration. So if you do have that, as part of your license agreement, then I can see that it could fall within the lease accounting rules.
Yeah, unless it's immaterial, I guess, if it's just a very small.
Yeah, that's it. I mean, those types of arrangements are probably less than 12 months. I would have thought those sorts of agreements.
Okay, well, I think we'll start to wrap it up. I mean, judging by the number of questions, I think that just shows you this has really got everybody thinking. So that's you can tick that box, Anna, because you've been trying to make people aware of the changes. Like you say, we've got 6 months, but it goes nowhere, does it, in terms of getting a plan together and collecting information. So thank you for helping us highlight that. And I suppose my thoughts is actually people need to engage with their accountants and advisors, whoever that may be, because you could put a lot of work in and then you go, this is what I've done, and they'd say, well, that's not our interpretation of what we want.
Yeah, so I would think conversation in advance.
Yeah, I would say the sooner you start engaging with your professional network, the better. So obviously RSM are available, other accountants are available too.
They are.
But they may not all be as up to date with the changes and actually starting to think about how they can help the clients. So you may get a mixed response. So the recording of this webinar will be available, and I think we're going to share the slides we've just said, but so I think it just remains me to thank everybody who's come along to this Headstar webinar, and to thank Anna again for her roadshow. She's got it off pat now, but I've heard it about 3 times, and every time I do it, there's something else I have to make a note of that I need to have a look at. So we really do appreciate your time, Anna. Thank you very much.
You're welcome.